So in the last video, we looked at what to trade when multiple setups align. What if I told you none of that matters if you don't understand how to control your risk? Because controlling your risk and your position size per trade is what is going to build your edge over the long term in the market. So let's look at this in more detail because it's really important. So what is position sizing? The definition of position sizing is determining how many lots to trade automatically so that every position risks the same fixed percentage of your account. And this is regardless of stop distance or pair. So what we want to do is get to a point where whenever we're taking a trade, we understand the maximum downside risk per trade. And that downside risk is fixed. Why do we want this? Because without fixed position sizing, one bad trade can essentially wipe out your account. And it's the only way to let your edge compound over time. Because let's face it, we're not perfect. We are going to make mistakes in the market, quite often as well. So we want to make sure that we're always protecting our downside risk and that our actual trading model is going to print us money over time. So the result, you can trade any pair, any stop distance, any setup, and always know your maximum loss before you enter. This means that your account grows systematically instead of randomly. So let's get on to how to position size. This is going to sound complicated, but at the end I'm going to show you how you can just circumvent this completely. And it actually isn't that complicated once you get your head around it. So your account balance times your risk is the amount at risk. So what does that mean? If you have a 10K account and you're only betting or trading 1% of your account per trade, you want to ensure that you only have £100 of risk or $100 of risk if you're working in dollars for every trade that you take. Now you can adjust this. This could be 1%, 1.5%, maybe even 2%. But you know before you go into a trade, you have a fixed amount of risk per trade. Once you know that, you can just do this. Understand your amount at risk, so in this case, £100 or $100, the stop loss in pips, and the pip value, which is something that you can get when you actually place your trade from your trading platform. So in this case, say the stop loss is 80 pips and the value per pip is 77p. You do £100, which is the amount at risk, divided by 80, the number of pips, divided by the pip value, 0.77 pounds, 77p. That returns a figure of 0.16 lots. So when you place this specific trade, that's how many lots you are placing in the trade to ensure that you're only risking 1% of your account. The good news, before we actually talk about why this is so important, is that every single trading platform I've ever used just does this for you. The key thing to take away here is that you want to fix your risk because this is going to allow you to let your edge compound over time. So let's just actually walk through what that looks like on the charts and then what that looks like over time. So on the charts, for example, we're not going to talk about the validity of trades, whether it was or wasn't a good trade. We're just going to see what happens when we place winning and losing trades. So let's just assume that we've seen price retrace into this monthly candle range and then try to push lower, already liquidating the low of the previous candle and then breaking higher. So this is what we're looking at. This monthly candle closes. Now we're swing trading. So this is looking at the 12-hour time frame and we're trading weekly, 2-weekly and monthly positions. So as soon as this month closes, we can confirm that we have a sweep of the previous monthly candle range. We're not going to look at the intermediate time frames here. We're just going to say that at this candle close here, we were hoping for a continuation to the monthly high. So we place a trade on the order block, covering the order block low, and we're going to target the opposing end here of this candle. We're seeing accumulation, manipulation, and now we're looking for distribution, and it's looking like a 3R. So it looks good. But what actually ends up happening? We lose the trade. So price just retraces immediately, and we've talked about why this happened. We lose the trade. What happens if you don't position size effectively? Well, you could blow way more than 1% of your account, or 2%, whatever it is that you're fixing at. you almost also might just chase this down. So you're holding the trade, hoping that it reverses. You don't have good stop loss management, and so that compounds even further. It is potentially extremely dangerous. What started as something that you want to make a 3R on turns into something that absolutely blows up or wipes your account. Hopefully that doesn't sound too familiar, but it does happen, especially when you're new in trading. So what do you want to do in reverse? Well, if you think it's a good trade and you know you've mapped it and this is what you're looking at, by all means take the trade. It didn't play out, that's fine, but you've maximized the loss in your position. So say it's a 10k account, you've lost £100 or $100. That's fixed. That's in your trade log, you move on. Then what happens? We get this displacement, price closes, and we get the liquidation of this 2-week candle range. So if I take the monthly away, we have closed above, we liquidated the high, and we've closed inside this candle range. So again, we're not going to look at this in too much detail, but you've now mapped that there is a fair value gap, a bearish displacement, inefficiency in price, and now you want to actually target the opposing end of the candle range. So you take a sell position, cover the liquidation here, and you're looking now for continuations, 3R. Let's just say you're fixed at, say, 2.5R. This trade plays out and you win. So originally you had £100 on the line for a 3R continuation. You lost minus £100. Now you've just hit a 2.5R winner. So you've made £250. So the net result of two trades by controlling your position size is now plus £150. So you're in profit on two positions. Now, how does this then compound over time when you have position size locked in? So essentially, let's imagine that we have a 10k account and we're going to fix our risk at 1% per trade. We're going to focus on driving a 2.5R return per winning trade. So we're betting £100 to make £250. Well, let's just say the win rate that you get on your trades is around 40%. In 20 trades, this is actually how it plays out. So you lose 12 of your 20 trades. Think about that. Trading a profitable edge, you still can lose 12 times and be profitable in 20 trades. Because those 12 losses multiplied by your fixed £100 is minus £1,200. However, you've won 8 trades at £250. So your profit is £200. Net the difference and you've made £800 over those 20 trades. So by locking in your position size and fixing your risk, you're letting your edge build over time and play out so that you're always profitable on your trading strategy. Now, where this gets really interesting is you can start to play with this. Because one, what you can do is scale up your access to capital. So for example, you can use prop firm capital. Now imagine you have a 200k account. With the exact same trading strategy, you get 8% return in 20 trades. Well, that's £16,000. And what's even more interesting is you can play with the numbers here, because you can increase your risk to say 1.5% once you're confident. That then drives this 8% up without you doing anything different. Second to this, we can also use the ability to get out of trades early by understanding when price is retracing versus reversing. And that's what we're going to look at in the next video. So stay tuned because there's a lot more to come on how to make this model very efficient. See you on the next one.